In international trade and project business, getting selected by the buyer is often only the beginning. Before work starts, before goods move, and sometimes before a contract is formally awarded, the buyer may require a separate form of security. That security can take the form of a bid bond, a performance bond, an advance payment guarantee, or a standby bank instrument. These are not side documents. They are often central to whether the transaction can move forward at all. In this episode, we are going to break down what these instruments do, how surety bonds differ from bank guarantees, where the real risk sits, and how exporters and contractors should think about them before signing the deal. The reason these instruments matter is simple. In many cross-border transactions, the buyer is taking on execution risk long before they see the final result. A government entity issuing a public tender wants assurance that the winning bidder will actually sign the contract and post the required security. A project owner paying for mobilization wants confidence that the contractor will perform. A buyer releasing an advance wants a way to recover that cash if the supplier fails to deliver. So the bond or guarantee becomes a financial backstop tied to a specific obligation. Without it, the deal may never start, even if the commercial terms otherwise make sense. There are three core instruments worth separating clearly. First is the bid bond. This sits at the tender stage and supports your seriousness as a bidder. If you win and then fail to execute the contract or provide the required follow-on security, the obligé may have recourse up to the bond amount. Second is the performance bond. This is tied to your obligation to complete the contract as agreed, and it is common in construction, capital equipment, EPC, and other project-based export transactions. Third is the advance payment guarantee. If the buyer prepays part of the contract price, this instrument protects that advance and can reimburse the prepaid amount under the agreed conditions. The names sound familiar, but the trigger and economics of each one are different. This is where people often collapse two very different tools into one mental bucket. A surety bond and a bank guarantee may both satisfy a buyer's security requirement, but they are not identical in how they work. A surety bond is a three-party obligation among the principal, the obligé, and the surety. It is generally underwritten with the expectation that the principal performs, and claims are often evaluated in relation to the underlying contract and whether an actual default occurred. A bank guarantee, including many standby letters of credit, is usually issued by a bank and can be far more documentary in nature. If the beneficiary presents the required documents exactly as specified, payment may be due even before the underlying commercial dispute is fully resolved. That distinction matters a lot. The biggest mistake companies make is focusing only on whether they can obtain the instrument rather than how the instrument can be drawn. Is it conditional, or is it effectively payable on first demand? What wording defines default? What documents does the beneficiary need to present? Does the guaranteed amount step down as milestones are completed or as an advance is amortized? Which law governs the obligation, and where would disputes be heard if something goes wrong? A guarantee that looks manageable on day one can become a serious source of exposure if the draw mechanics are broad, vague, or disconnected from the commercial reality of the project. These instruments also do not live in isolation. They usually sit alongside the rest of the finance structure. A bid bond may be required before the contract is awarded. A performance bond may have to be in place before shipment, fabrication, or mobilization begins. An advance payment guarantee should be aligned with how that advance is actually repaid through milestones or deliveries. And if the broader transaction involves export financing, working capital support, or EXIM Bank-backed facilities, those obligations need to be looked at together. Sometimes the real constraint is not whether the buyer wants a guarantee. It is whether issuing that guarantee consumes bank line capacity or creates collateral pressure that affects the rest of the deal. Impello's role here is advisory. We do not replace your bank, your surety underwriter, or your legal counsel. What we do is help you see the structure clearly before you commit. We look at what the contract actually requires, whether a surety instrument or a bank-issued instrument is the better fit, where the draw language creates risk, and how the security requirement interacts with financing, insurance, and cash flow. Where EXIM Bank support or private market solutions are relevant, we help identify that fit as part of the wider transaction. The goal is not to tell you that one instrument is always better. It is to make sure you understand the obligation you are taking on and how it affects the full deal. The right bond or guarantee can unlock a contract that would otherwise stall. The wrong one can introduce collateral burdens, payment risk, or claim exposure that outweighs the economics of the underlying deal. If your buyer, tender authority, or project owner is requiring security, it is worth slowing down long enough to understand the exact form of obligation being requested and how it ties back to the contract. In the next episode, we move to letters of credit and why banks still sit at the center of global trade. We will cover how documentary letters of credit work, which documents actually drive payment, and where exporters most often get tripped up. Subscribe so you do not miss it, and drop any questions about bonds and guarantees in the comments below.